Welcome to TheoTrade. This is Don Kaufman. January 1st, 2021. You made it, everybody. Happy New Year on behalf of all of us here at TheoTrade. And with that, it's a new year. Let's trade like it. Let's get right down to business with a quick review of this past week of trade. There's a few factors in the previous week of trade that I think are critical to be able to, of course, look forward into 2021. And one of those, of course, being the marketplace continues to kind of grind a little bit higher here. I'll tell you what. So low liquidity throughout the course of the week. Again, we did grind higher, but the key point of us grinding higher, we actually hit the upper edge of the expected move. And when I say we hit the upper edge of the expected move, for those of you that had the butterfly on to the upper edge of the expected move, that thing is a grand slam home run. The upper edge of the expected move in the SPX was literally 37.61. So if you had a butterfly on, the upper edge of the SPX butterfly literally would have been centered right around 37.60. Okay, we closed the week at what, 37.56? Again, grand slam home run on the expected move butterfly. But I'll tell you what, that doesn't necessarily impact trade moving forward. Let me get down to business of what does start to impact trade moving forward. Okay, a few very key takeaways into the next week of trade. And I'm kind of backing into this. We're going to talk again about the SPX, because coming into this first week of trade of 2021, well, the only way to say this, put on your big boy pants, because we're going to have some volatility in this coming week. You know, obviously this last 2 weeks, okay, we had reduced expected moves, but it makes sense because, again, this past week only had 4 days of trade. So we were sitting on about a $58 expected move. Now, the first week of the year, now there's going to be, again, a little bit of politics in this first week of trade here of January. But the expected move, I'll just kind of round it for you. You're looking at plus or minus, okay, $90 move. Again, a plus or minus $90 move. That is $90 higher, $90 lower. You can exceed, and literally visualize with me here the expansive move versus the previous weeks of trade. So we're going to be sitting on one of the largest expected moves that we've seen in quite some time. And again, I want to enunciate just that. So, the week closed roughly, and I'll just round it for you here. The week closed at like 37.50. I mean, you're going to move up almost 100 points in the SPX or down almost 100 points in the SPX. And yeah, that means something. Okay, it absolutely means something. It means you better wrap your risk if you are not comfortable with whatever you have on right now. And that's one of the first things I really wanted to kind of enunciate on here is you're coming into a very heavy expected move in the first week of trade. And I got to tell you, beyond that, there's a few other factors that are kind of standouts. So we do have the volatility index. It's still bid. And if you've never heard this kind of, this comment before, this line on the screen over here, and again, the VVIX, it's the volatility of the VIX. Okay. So when you're looking at the VVIX, looking at a chart, what you're actually looking at a chart at is, again, vol of VIX. So it's the volatility of the VIX. The volatility of the VIX is still north of 110. That line on your screen is the 110. It's kind of like the Maginot line of volatility. Anything above the 110 level, I denote is what we call the VAMA zone. And VAMA means the volatility, basically, of the volatility in here. And this is a pretty serious number when we're still north of 110. But you know what? Okay, most of this past year of trade, where were we? I mean, right up in this VAMA zone, kind of sitting on pins and needles. But we're entering into the new year, again, with elevated volatility. It's not just the VVIX. And I was talking about this quite a bit over the past week of trade and in last weekend's update. If you take a look at the skew. So the skew, and I'll actually drop down over here. I'm going to load up a style. I actually built a style just to be able to look at this. Listen, skew is only calculated at the end of the day. And what skew basically means is it's the out-of-the-money puts, okay, in the S&Ps versus the out-of-the-money calls. And what it says is the out-of-the-money puts are trading, okay, with an extraordinary volatility above and beyond the out-of-the-money calls. And in this case, the skew is it's a monstrosity. Okay, it's for the most part, you're like, well, what does that really mean? Kind of in context. In context, okay, what it means is when you start looking at products like the spiders, and you go out maybe 30 days in the spiders, and I'm just opening up all strikes in here, and I'll actually pop to implied volatility. Okay, it means these out of the money puts are trading for an extraordinary premium, okay, versus the out of the money calls, which in turn, and again, I see the S&P's exploding to the upside, but in turn, what that really means, so the puts are trading for a premium over the calls, which is kind of normal in an index product, but the skew right now is at an extreme level, which once again dictates that there are quite a number of hedgers in the marketplace, meaning that there are traders that are out there buying puts, and a lot of times they buy puts and they'll turn around and then finance the cost of those puts by selling out of the money calls, and that skew, it's dramatic. It's dramatic. So we have, again, a really large expected move. Okay, we have a high VVIX, we have a heavy skew. Now we can attribute all of these factors to some of the political showcase that's going to go on this first week, right? You know, the Georgia kind of runoffs, again, some of the politics, you know, the official certification of the presidential vote's going to happen in here. Neither of those, though, kind of explain some of the fireworks that we are likely to see in terms of this expected move. And, you know, moreover, and again, I've been detailing this a lot lately, moreover, when you start looking at the aggregate implied volatility, and I just wanted to bring you into this is the implied volatility skew. So what you're looking at right now is like, this is Monday expiration, this is Wednesday expiration, this is Friday expiration. Of course, we're also going to get quite a number of numbers. The unemployment report will be out. You know, there's a lot of, you know, economic data that's going to pour out in the coming days as well. But again, the volatility skew is incredibly flat right now. It means, you know, the risks in the near term are about the same as the risks in the far term. I'll show you one other aspect, and this one really resonates with me here. You go over to the IWM, okay, the Russell. The Russell right now is sitting, you know what, its 30-day volatility is upwards of like 31%, okay? Big volatility inside of the Russell. For those of you, if you like scalping on an intraday basis, okay, and you like scalping in index-related products, the IWM and the Russell product, like this thing, again, it's a major index product that's trading over 30 volatility. You're like, well, so what? Like, look at the Nasdaq. Look at the Nasdaq, okay? The Nasdaq's nowhere near it. I mean, the Nasdaq, again, 30-day volatility is more like, you know, 25, 26%. So the Russell right now, the Russell is a rocket. And this is actually one of the things I'm watching, because with the Russell with such high volatility, it leads me to the belief that you're also going to see some fairly dramatic volatility, specifically inside of the financials. Okay, they too are sitting with elevated volatility. Then again, all right, in the first couple of weeks of the year, we have financials that are going to be entering their earnings season. So things, I'm just telling you right now, okay, they're about to get a little bit nutty. Okay, I'm not going to sit here and talk about like the MACD and a Fibonacci, because I'm going to tell you right now, based on the factors that I see with implied volatility, and again, I am a quantitative trader, I'm a quantitative strategist, right? Based on the factors that I see with volatility and volatility alone, this is going to be a little bit, again, of what I kind of term Mr. Toad's wild ride inside of the marketplace. You know, you can say that all the momentum's to the upside, and that's fine and dandy. But at the same time, you have, okay, the hedgers presenting a case that, well, they're hedging. You can tell that. How can you tell that people are hedging? Well, the skew is really high. The VVIX is really high. I mean, the volatility itself, it's elevated. Right? You're sitting in a marketplace at an all-time high, okay, with volatility elevated. It just doesn't give me a warm and fuzzy feeling, you know, to you know, when you go home at night, you're like, oh yeah, this is you know, really, really good, right? All-time highs. All right, we're up in the nosebleed section on a lot of stocks like this. I mean, levels that no one's ever seen in terms of like PE ratios and so forth, elevated volatility stance, and coming into the front of a year. Yeah, it's got all the makings of a very, very volatile time coming up. So with that, again, keep in mind, all right, I'll be trading a lot more of the Russell in days and weeks to come. I think that's going to be quite opportunistic. All right, to completely switch gears on you now. Okay, I am also in the coming days going to be introducing a portfolio, and I'm going to run this just like a regular trading book. Okay, it's a TheoTheta Portfolio. When I say I'm going to run it like a trading book, we're coming in here no holds barred. I'm actually going to allocate a very extensive inventory. It's something I do on a day-to-day basis. Like I always show people what my aggregated risk is, what some of the positions I have on. Okay, but we're now going to run this book, and I'm actually going to SPY beta weight this. Okay, we're going to start running my own positions in my own portfolio. We're going to run this just like any other trading book in this particular circumstance. And again, this is just a quick glimpse at some positions. And in fact, I think it's probably a little easier to look at some of the aggregated risk or even total up both accounts in here. Nevertheless, the point that I am trying to make with this, and I'm going to go through some of the details of this, is we are going to be running a full-fledged trading book. All right, it is going to have every strategy is going to be available to me. So full spectrum of strategies. Most of the time when I am sending out positions via text message, discussing positions in the, in the chat room on a day-to-day basis, most of those positions are isolated, meaning I put on like a gamma iron condor, I take off a gamma iron condor. I put on an in-out spread, I take off an in-out spread. This particular portfolio is going to differentiate. It's the first time I'm actually going to do this. Again, I said I'm going to run it like a trading book, and I'm going to run it like a trading book. Effectively, what that means, I'm going to open up and actually allow you to see pretty much everything in the inventory step by step. Some of the positions in there, we will have the sale of naked premium. It's going to be viable for this particular portfolio. We've come to the conclusion that we definitely have a number of portfolio managers, of course, that are following us here at TheoTrade, but clientele that are a little bit more astute, that are capable of selling naked premium. By the way, there are absolutely no margin constraints in this portfolio, of course, that we've created. If you are and have any margin issues, all you have to do is actually trade, and I'll kind of close that up for a second. You can come in here and you can actually trade some of the micro contracts. So the micro contracts, this is options on micros and so forth. It is going to be far more efficient in terms of your margin requirement. And again, what you're looking at here is an option on a futures contract. There's no day trading margin restriction on options on futures contracts. There's no day trading margin restriction on any of the futures contracts. If you're unfamiliar with options on futures, well, you get yourself familiar. Now, we're actually going to handle some of the education behind that. So options on futures and using these micro contracts can be a great substitute. Most of my positions, you're going to see me actually trade inside of the spiders, the QQQ, a little bit of the IWM. I'm not just going to restrict myself in this portfolio. I'm not just going to restrict myself to using index and index ETFs. The portfolio will also use what we term tactical hedges. If you're unfamiliar with that term of tactical hedges, if you look at something like the VIX, these are trades that I talk about all the time, right? You're going to see me with the use of VIX volatility spreads. VIX volatility spreads. These are using way out of the money options in the VIX as a hedge against the sale of naked premium elsewhere. That is completely open. I'm going to be using risk twist spreads over there. And last but not least on this portfolio, understanding of Greek risk, is an absolute must. And that is the entire portfolio is going to be managed. And I want to reiterate this time, but again, the entire portfolio is going to be managed with the use of course, Delta, Gamma, Theta, and Vega. So know your Greeks, people, because you're going to see this on a day-to-day basis now at TheoTrade. Again, it's a TheoTheta portfolio. Obviously, one of the key things in this portfolio, I'm going to be having positive theta, but I am also very likely to incur some directional risk. Right now, I'm net my aggregated portfolio. Well, you're looking at it right now. I'm short about 2,500 SPY deltas. And again, you're going to be able to follow every single step of this portfolio. For those of you that are brand new to it, if you use it just as a learning curve, phenomenal. Get you ramped up into it over time. But as I said, this is going to run like a trading book. People, it's not going to be put a position on, take a position off. We're going to be running a very significant, stocks, options and futures inventory all kind of commingled in here. And we will have ways for everyone, for the most part, to be able to follow along, of course, with this particular portfolio. Again, in the weeks that follow, be on the lookout for, again, some fairly tumultuous volatility. I think that if there's one major takeaway from what I would look for 2021 is going to be continuation of volatility. The marketplace, also very recently has had some changes in terms of tone. That's another thing that I want to bring everybody into scope before we actually not only jump into this TheoTheta portfolio, but really into the beginning of the year. Change of tone in the marketplace. The monsters of tech, your Microsofts out there, Apple, Amazon, all trapped in a range. And you can actually attribute a huge amount of the action inside of this last year of trade, a huge amount of the action specifically inside of the Nasdaq can be attributed to one stock, and that's Tesla. Now, with Tesla added to the S&P 500, again, it's going to change the tone of the marketplace. At this point, I'm going to tell you, early on in the year, keep your hands and feet inside of the vehicle. Keep your allocations small. In most cases, again, people are going to allocate a little bit too big coming into the front of the year here. Again, we have expanded volatility on the horizon. Trade for just that. Thanks, everybody, for joining us here at TheoTrade. Once again, Happy New Year. Have a great weekend. Bye-bye.